In the third quarter, there was really no place to hide, and any exposure outside the US dollar or US markets hurt rather than help performance. So diversification across currencies and asset classes detracted from performance. The MSCI All Country World was down about 6%, 25% year to date down in dollar terms. There was no benefit in style biases. Value, quality and growth all struggled. So too did a size bias. Mid-cap, small cap and large cap all struggled. Gold lost 7.8% in dollars for the quarter. The bonds were down 6.9% and credit was down 5%. So one can see even across asset classes a terrible quarter. Diversification across currencies really did hurt, with the dollar being king for the quarter. Sterling lost 9%, largely due to their own issues. The yen was down 6.5% and so too the euro. So why did this happen? Well, firstly, inflation has just been a lot stickier than the market expected. Secondly, the Fed did an about turn in its strategy and its communication. So in March, the upper band of the Fed funds rate was 25 basis points. We're now looking at 3.25%, and our expectations is that the Fed funds rate will probably reach 5%, if not 5.5% in the year ahead. The real problem is the market's not sure of the terminal rate and where inflation actually peaks out. So year to date, the fund is 4% ahead of its benchmark. It's done really well. We struggled in the quarter. Our currencies, obviously outside the dollar, hurt. We have no reason to sell those. We believe the dollar is expensive. And we do appreciate that with the Fed fund rate rising, you just don't fight the Fed. But it doesn't change the fact that on a longer term view, some of these currencies are very cheap. Secondly, our Chinese equity exposure, not a large exposure in the fund, but really did hurt for the quarter. We've had it for a very long time, a few years, mainly Alibaba and Tencent. And then a core European stock also hurt performance. So too did not owning Apple, which we believe is overpriced. Just in terms of going forward, the intrinsic value discount on our buy list is 35%. It's one of the highest it's been. That said, though, we all know that with rates rising and earnings expectations probably too high in markets, that there will be more compression on the multiple, and we think tougher period ahead for equities. So our central theme is buy opportunistically as we're doing, but don't fight the Fed.